Hey guys, welcome to this video on Python value investing, screening stocks for opportunities. Uh, Before I start, like there were a couple of questions that people asked me, like why are you doing all this charting and stuff? Like, what is the point of doing this stuff? Well, it's a couple of things, right? Like trends are your friends till the end, right? And we do this on the Trinity, right? Income, balance sheet, cash flow. So let me give you a little sort of a brain thing. So if you if you like ever watch like Warren Buffett or any of these investor guys like interviews, like they'll tell you what they're doing, right? And they don't necessarily tell you like exactly the methods and strategy, like the tactics that they employ. But one of the things that they look at, probably the most important thing they look at, is actually trends, right? So the data means nothing. So if you look at this Kraft Heinz Yahoo page, for example, right? If you look at their financial information, like you'll notice that there's tons of data, right? You know, income statement, balance sheet, cash flow, all of them have tons and tons of data, right? Like some of them have like hundreds of rows and like hundreds of columns, and it's just insane amount of information. If you're an investor, if you look at that, how can you tell is companies good or bad? Like, are they making money? Are they losing money? Are they growing? Are they shrinking? Like, you can't really tell, right? And the reason you can't tell is because, well, human brains and computer brains are different, right? Computer brains, computer like algorithms and AI in general, they are trained. They are really good at looking at data and figuring out, just basic information from just looking at like binary information. Humans are not good at that. Human brains are not designed for that kind of stuff. This is why self-driving AI cars, their brain and human brains are like completely different, right? And if anybody says they're the same, I work on AI stuff, and they're not the same. Okay, uh, human brains are really good at looking at analog information and determining like what to filter out really quickly. This is one of the reasons why, if you look at the data throughput of a human eye, right, they're measured in like petabytes per second, right? I mean, like human brains, like the stuff you see through visualization, like graphs, charts, like pictures and stuff, that information gets processed like billion times faster than like the world's fastest computer could ever achieve, right? So data means nothing. Humans are really good looking for like patterns and charts and stuff like that. Okay, like the reason why I tell you this is because if you look at only the visualization for data, right, you're gonna get wrecked. Like for example, look at Kraft Heinz, right? If you look at this, you see the picture I showed you there. It shows you that Kraft Heinz is doing well, and that's just one day, obviously. But if you look at the data from the past like 20 years, right, you'll notice like it's going up and up and up and up and up, and then all of a sudden gets wrecked, right? A lot of people got in at the top because they're just looking at the data from the past, right? Like if you look at everything in the past, if you look at Google, Facebook, their stock went up like straight up like this, right? Because a lot of people, well, they basically follow the instructions of other investors, right? They just go wherever the people go, right? They don't really do any kind of like fundamental analysis or anything like that. Yes, there's like accounting tricks and stuff like scams that people do too. I mean, that nobody can get you away from that, right? I mean, your job is to look at data and then make a decision. And how do you know if people there's scam involved? You can't tell, right? But that's a separate issue. But if you look at just data, you can't tell if this company is like, how is companies doing. And most of the time, people only look at data, price data, right? They only look at price data and they make a financial decision based on that. And if you do that, you will get wrecked. Okay, so just heed my warning. You should not do that. You cannot just look at. You can't tell if a person is healthy just by measuring his height, weight, and taking blood pressure. You can't, right? If you want to if you want to see if this person has cancer or this person healthy, you got to do all kinds of other stuff, right? So let me give an example. Suppose, let's use a hot dog stand. For some reason, people love hot dog stand examples. Suppose I sell hot dogs, and I'm gonna sell Korean hot dogs because, well, I'm Korean, so And if you never had a Korean hot dog, oh my god, they're delicious. It's like really bad for you because it's like basically corn dog wrapped in like French fries, and they double fry it, and they put cheese and sugar and ketchup and all kinds of stuff. Actually, I'm thinking about it. It makes me hungry, but it's friggin' delicious. If you never had it, I really recommend you go out to a nearest K town, or if you go to Korea, just try it because it's friggin' delicious. It's only like $1. Don't eat it every day because it's really bad for you, but it's friggin' delicious. Anyway, suppose I sell Korean hot dogs, and I start from one hot dog cart, right? And I do well, right? And I keep expanding my business, and eventually upgrade, right? My business expanding, and I'm starting to make a lot of money, right? So at this point, um, as any entrepreneur is probably thinking, like, if your business is expanding, there's a couple of things you can do. Number one is just expand, or number two, just keep the profits. Because if you think you're in a shitty market or something, right? So how do you decide, right? How do you decide whether you should expand, whether you should take investors' money, whether or not you should take on debt? Like, you just don't know, right? So there's three types of cash flow that you can generate, right? Is that you could just keep selling more hot dogs, right? You get a new truck, you get better quality hot dogs, you make increase you make better batter and make it more delicious or something, right? You can move to a better location or whatever my case might be. Suppose you make a ton of money, right? And what do you do after that? Well, if you make a ton of money and you just put it into a bank account and do nothing, obviously the money's just going to rot, right? It's not going to do anything. So what do? You put it into a savings account, money market, maybe you put into a fund or something, right? It generates more returns, more cash flow. But that is not core to your business, right? Like, you sell hot dogs, like, whether or not you put money into a, like, some Vanguard fund or like some Schwab fund or something, that has nothing to do with hot dogs, right? The market could go up and down. People are still gonna eat hot dogs regardless, right? How about the other side of business? Well, you could, let me move my head there. You could raise funds, right? You could raise funds from an investor or get a bank loan, and then you buy more trucks, right? I could just sell more hot dogs. I could expand my locations. I could franchise. I can, I don't know. I can, like, do a bunch of stuff, right? But that involves me taking people's money, paying it off, whatever the case might be, right? There's that the activity of doing that affects my business. Is it core to my business? No, it's not core to my business, but it affects my business, right? So here's the thing. So you have, sorry, let me go back. Remember, so this business, you can generate, your business could make profit, right? Profit, by doing multiple things, right? You could take on more debt. You could, like, sell shares. You can get bank financing. You can pay off bank. You sell more hot dogs. Like, there's all kinds of ways, right? So here's the thing: if you do all that stuff, how do you know if this business is good or bad, right? You just can't tell, because just looking at the stuff that Yahoo Finance publishes, or anybody publishes, you can't tell just by looking at numbers. I mean, just by looking at sheer numbers on the Excel spreadsheet, you just can't tell. So you have to look at charts. Okay, so going back to the trends are your friends. This is kind of obvious, right? What do you want the income statement to look like? Obviously, revenue goes up and costs go down, right? I mean, not rocket science, right? How about balance sheet? Well, it should show that you have more assets than you have liability, right? I mean, not rocket science, right? I mean, this is like, I think any kid, anybody with a, like, more, better than a third degree. I mean, sorry, uh, what is it? Elementary school level education should understand this, right? You should have more income and less costs, and obviously, you should own more stuff than you owe, right? I mean, common stuff. But here's a question: remember the cash flow stuff I mentioned? There are three types of cash flows, right? Cash flow from operations, cash flow from investing, and cash flow from financing. So ask yourself this: which of these trends should be up and which of these trends should be down? So I'm going to give you about 10 seconds to think. You can actually pause this video if you like, and let me know what you think should be up and what you think should be down. And if you could put in the comments below why cash flow from, these cash flow should be up or down. Okay, so I'm going to give you a couple of seconds. You can pause this video if you need to think about it. Okay, So I'm going to tell you the answer. These are the way that your trends should, in general, look like. Right? Cash flow from operation. So money that you generate from operating your business should generally be up. Why? Because, well, that's what businesses are, right? You have to make more money. That's it. That's the bottom line. But what about cash flow from investing, right? Let's go back to this example. If you invest money, should the money be coming to you, or should it be going away from you, right? So you have to think about that for a second. Should the money that you invest, the cash flow coming from as a result of investing, should be coming to you or should be going away from you? And the answer is it should be going away from you. Why? Because you should be investing, right? If your business is doing well, you should be investing, right? You should be buying more trucks. You should be buying more equipment. You should be buying more inventory, right? Like that's how you know that your business, you're gaining market share, right? You're expanding locations and stuff, right? How about cash flow from financing? Should it be up or down? This is a little bit tricky one. So cash flow from financing should, in general, be negative. Why? Because cash flow from financing, if it's negative, that means you're paying off debt, right? You're paying off your investor. Like you are doing things that basically, whatever institution lent you money, you are doing your fiduciary responsibility of, giving them the return, right? So you see, that wasn't very intuitive, right? Like you would think that cash flow from investing or finance should always be positive. No, that means you're taking on more debt. You're like selling more shares. You're diluting more shares. You are, instead of like buying inventory, like you're getting back inventory. Like, people are returning your stuff because they don't want your crap, right? So this isn't intuitive, and you can't really tell by looking at charts. Like, is this like positive, negative? Like, is this good or bad, right? Like, plus and minus don't mean anything. It's basically, is it good or bad for the business? If it's good for the business, if you are the investor, it's probably good for you. And if it's bad for them, it was bad for you too, right? So this is the reason why we do charts and visualization. And this actually, like, I didn't know this till like maybe like 10 years into my life of doing investing, that I should be looking for these trends, right? Obviously, the debt to equity stuff, you do definitely need to look at, because if a company is growing, right, you should be gaining more equity, right? Makes sense, right? Like if you're making more money but you have more and more debt too, that's might not be good. However, I say this with a caveat, going back to this, where is it? This doesn't necessarily apply to all companies. Like, for example, real estate investment trusts, like guys who make money, putting up buildings and renting them out. This is not gonna. These charts look completely different than guys who do like tech, or who do like consumer products, or do like, I don't know, some non-relevant company like consumer products companies, or Starbucks, or retailers. They're all different. So the reason why you should look at this is because if you look at this, you shouldn't say like, oh, this guy on YouTube told me that I should look for this and it doesn't match this, so it's a bad stock. No, you can't look at it that way, because you have to compare apples and oranges and oranges, right? So if you're doing an analysis on REIT, well, you should look like other REITs, right? Or better than other REITs. And if you do tech company, it should look like the trends of other tech companies, right? So there is no one trend that answers all, right? It all depends. Real estate guys constantly raise money to put up more buildings, right? Because if you rent out an apartment, you can't rent out to like 10 people, right? Like 10 families. You rent out to one leaser, right? Like one leasee, right? You're not renting out to like 30 families, right? That's not, it's illegal. And tech companies are different because you write code once and you sell it like a bunch of times, right? Like look at Microsoft. They wrote the code once and then they sold it like billions of times, right? So trends are different for everybody, and you do need to be aware, because, well, trends are different for everybody. So anyway, going forward, I'm going to be talking about this. Like, this is one of them, right? So we're not this Python value investing. I'm going to be covering more in depth, like not nitty gritty details of financials, and I'm not going to go over like industry sector overview. I'm not there's guys who specialize in specific sector, at like a bunch of these companies, right? So I'm just gonna tell you exact general over a trend, and if you want to delve more into nitty gritty industrial sector stuff, like that's completely up to you. And if you do your YouTube channel and mention me, I'm happy to chime in and stuff. But it's gonna be general overview, and when I do these charting and stuff, you understand why um, these things are correlated to that, and you'll get an idea of how these things sort of match up. So anyway, that's it for this video. I'll see you in the next one.